Hello, Doc Severson here for the ReadySetCrypto OMNIA newsletter market update for Wednesday, the 12th of February. There is about an hour left to go in the trading day before things start printing the next candle here. Now, I did get a question today in Discord, which I thought was really interesting in terms of what can you do to trade against something like this. So we're looking at this massive move here into just this completely parabolic run. If we throw this on the RSI Laguerre for Ethereum, we're going to see, I predict, exhaustion. And not just exhaustion, but just completely crushed, right? So what can you do with something like this? Can you short it? Well, maybe you could do that. You could play a very quick move down if and when it happens with futures. And most of the larger brokers do have Ethereum futures available for you. What's nice is the notional value of the futures is much smaller than Bitcoin. If you compare it versus a $10,000 Bitcoin, this is just a fraction of that. So what we can do also, though, is we can play options against this. This is where it does make sense to maybe just place a long option. If we think that there's going to be some kind of a pullback in the next 2 weeks, which I think would be reasonable, what we can do is kind of calculate the expected move. If we say that Ethereum right now is 268 and change, let's go over to the 270 level and let's get some quotes here for that. So if we look at this and we say, all right, roughly this is 21. And these are the calls over on this side, and these are the puts over here. So this is roughly, here's the bid, and here's the offer. Let's just say that this is 21. All right, now we're going to look at the other side, and let's just say that this is 18. If we add the two together, 21 and 18, it's 39. Let's just say that this is a 40-point expected move. So there's a $40 expected move plus minus between here and the end of February. So if we put that expiration date on the line here for 28th of February, and let's go ahead and grab ourselves an arc. And if we say that there's a 40-point expected move between now and the end of February, if we take 270, which is the current price, and we add 40, that is 310. So we're going to mark this at 310, and the downside target is going to be 270 minus 40, or 230. So right about there. And if we pull out the arc, there is our probability curve for the next 2 weeks. So we could play this either way that you think. If you think this is going to just completely explode higher from here, then maybe what you could do is play a call option. The problem with call options is that more than likely implied volatility is going to continue to crush from here to the upside. I think there's, based on what I'm looking at here, there's maybe a better than even probability that we may pull back. So it could pull back, it could go sideways and pull back, it could do anything like that. There's a 68% chance that the price will end up somewhere in this probability cone by the end of February. Okay, but just common sense maybe thinks that a pullback may be a good thing here. We're, getting a little bit heated across the board. So let's go back out to that option chain. Now, normally, if you're dealing in long options, most of the time what you're told is, well, find the option that has the 70 delta option. And let's see if we have delta on here. There's delta right there. Okay, so if we were going to play the call option, we would look for about a 70 delta. And this is pretty reasonable. We could buy the 250 calls, which are slightly in the money. Couple strikes in the money here. And those are going to run us about maybe $33 for that. Or we could just say, let's Let's be really speculative here, and let's play the out of the money calls. The problem is that the value of those will crush, as well as the time value that it takes to get up there. Where you have a little bit more edge is if the price actually keels over. So if it goes up like this and then keels over, why? What happens to implied volatility? As the price is going down like this, the implied volatility will go up like that, and that will inflate all of these options over here on the put side. Yes, they also inflate the options in the call side, but especially in the direction that the price is moving. So we could look at this and say, why don't we just play a put option at the target expected move? And that's going to be about somewhere about $4 to $5 to get into that, which is, if you want to know how much that option will be worth by the time it gets down there, we can just kind of look at the current. Now, this is a really rough way to do that, but the current price of the at the money option is about 18. It's about $18 if we were to buy that right now, about $18, $19, something like that. Right now, this is about $4. So if the price did come all the way down, and I know that this is weird because the prices are going down, these are the strike prices going down, but if the price did go from 270 down to 230, this option that's currently going for $4 would turn into at least 18, unless it took forever to happen. Unless it took forever and the next 2 weeks for that to occur, then there'd be no extrinsic time value left, only intrinsic. But that would be over a 300% return if that were to happen. So again, for $4, I think this would be, and that's leveraging one contract of Ethereum, one Ethereum coin for that, which again is that's a big advantage between doing these Ethereum options, is that there's a lot less notional value. So of course that's Deribit, and Deribit is pretty much excluding US customers now. You have to do KYC just to do trading now. So they haven't kicked me out yet. But don't forget also with a Deribit that you have to have Ethereum coin to be able to trade Ethereum. But this is an example of a trade that you could take, and there is no stop for something like this. You look at the risk that you're taking, which is about a 3 to 4 to 1, which is pretty good. And you're limiting your risk to what you're paying for that option. So there really is no stop for this, so you don't have to worry about it. Anyway, just an example of something that you can trade for today's movement instead of chasing after something like all the other retail chum that are out there. You can trade something in the opposite direction that gives you some edge. That's it for today's report. Thanks for listening. We'll see you tomorrow.